Hi, everyone. Welcome to today's webinar. We're just going to give folks a minute or two to get into the Zoom, and we'll get started. Well, welcome, everyone. Thank you so much for joining the Building Energy Resource Hub's Focus on Finance series, Financing Energy Project with CPACE. We're really excited to have you all here today. My name is Katie Kaluzny. I'm the Deputy Director at the Illinois Green Alliance and Acting Director of the Building Energy Resource Hub. We are starting a finance series with this session, and we'll be having more coming in the coming months. We're looking forward to jumping in on CPACE today and having some really great presenters explain this great tool. Before we get started, I just wanted to share a little bit of logistics. You are muted upon entry in the webinar, but you're more than welcome to add your questions to the chat or the Q&A as we get started. You'll also receive a follow-up email with the recording as well as a PDF of the slide deck that we'll be sharing today for any additional questions. Before we get going with the webinar, I just wanted to share a little bit more about the Building Energy Resource Hub. The Hub is serving as an objective resource for the building professionals of all levels of familiarity with energy efficiency. This is a project of the Illinois Green Alliance, which is a nonprofit organization serving the building community throughout Illinois. Our goal is to serve Chicago and Eastern Illinois stakeholders with critical training and resources, ensuring that the region can meet aggressive climate action goals within the building sector while building an inclusive green economy. Some of the industry resources that you'll find from the Building Energy Resource Hub are playbooks and guidance for the different industry types, such as engineers, contractors, developers, and owners, technology primers on really specific technologies that you can use on your building to improve performance, project financing pathways, like the webinar that we're hosting today, some areas to find a service providers to work on your projects that you're building, case studies of past examples, an area to ask an expert your questions, and for you to share your expertise with others. So it's a really great new tool. We've just launched it a couple of months ago and are excited to get started with these programs. If you want to learn more, the Building Energy Resource Hub website is here on the screen, as well as through the QR code here. But now we'll jump into today's session about CPACE. Our first presenter today is Brad Fletcher. Brad Fletcher is the Senior Vice President at the Illinois Finance Authority, which is a self-funded state agency. Brad leads the Illinois Finance Authority's conduit financing team and primarily facilitates the funding of eligible projects for commercial and industrial borrowers and higher education and nonprofit borrowers, in a tax-exempt private activity bond market. In his role at IFA, Brad developed the nonpartisan, nonpolitical Illinois Finance Authority PACE program to accelerate private investment in PACE projects in any county, city, village, or unincorporated town in Illinois. Brad, I'm going to let you take it away and tell us more about PACE.
Thanks, Katie, and welcome to everyone, and thank you for joining. I have a few slides to kind of develop a baseline for our collective knowledge, and then Julie will be representing the perspective of the capital providers, which is a term of art for this industry from a lender's perspective, said another way. So our first few slides are a little dense, and my apologies, and we'll probably spend the most time on this first slide. This first slide on slide 6 is really to develop this baseline. Before we can step into CPACE financing, we need to understand, of course, what a PACE project is. So stepping through the slide, CPACE financing, CPACE is an acronym, of course. It stands for Commercial Property Assessed Clean Energy. The statutory term for these projects is PACE projects. And CPACE financing can be used by owners and developers. I'm going to carefully step through each of these provisions and these bullet points for points of emphasis. So beginning with this first proviso, owners and developers, you have to be the record owner of the property to to at least undertake a CPACE financing, or you have to be a developer looking to acquire a property And at the time of acquisition, you can undertake a CPACE financing. So it's for current owners or future owners. And such property owners can finance or refinance eligible improvements. Point of emphasis there being this can be for new financing, for a new construction project, or this can be used for refinancing construction projects that have already come to completion or are still in the stages of construction. With respect to eligible improvements, state law defines what is eligible for CPACE financing. And then there are sometimes, not all the times, further programmatic limitations at the local level on what can qualify or not qualify under a PACE program in a PACE area. Importantly, however, and we'll step through the various types of eligible improvements in the next slide, the eligible improvements under state law and under any particular PACE program must be permanently affixed to any privately owned commercial, industrial, non-residential, agricultural, or multifamily property of 5 units or more, or as of 2019, any property owned by a not-for-profit. What's left out there is any property owned by a governmental entity or any single-family home residential property. So this is, again, commercial property assessed clean energy financing. CPACE financing is available in roughly 35 states throughout the country. And in fact, on a limited basis, is available in the international market. In some locales in Canada, South Africa, and Australia also offer forms of CPACE financing. But we are not discussing residential PACE or our PACE, which is only available in Florida, Missouri, and California. Again, this is available for renovations of existing buildings. So if you have an adaptive reuse or a deep energy retrofit of a data property, this is a great way to incentivize capital to fund your retrofit project or adaptive reuse project. Or this can be used for new construction. A general rule of thumb for new construction is any type of permanently affixed improvements that you are installing on your property, to the extent they are above and beyond the building code, they qualify as well. All of this is caveated by the fact that state law caps the amount of CPACE financing any new development or retrofit project can utilize up to 25% loan to value of the property. Now, that's a very specific number. Most states are at 25% under their state laws. Some states will go up to 30 or 35%, but those numbers are very specific and very specific for a reason. CPACE financing is intended to work quite well with mortgage financing. For those of us that are familiar with conventional mortgage financing, in the olden days, and I'm using air quotes here, your mortgage financiers will typically loan 70 to 75% LTV, meaning your prospective property owner or developer had a gap in their project budget of 25 to 30%. And so CPACE is really intended as a gap financing measure to work quite well with mortgage financing. But in today's macro economic market, and headwinds is probably a better word, I think we're traditionally seeing traditional lenders, banks, somewhere closer to the 55, 65, maybe 70% LTV tops. So CPACE financing is quite valuable in a high interest rate environment because it's quite more affordable vis-a-vis mezzanine financing, utilizing cash from a developer's equity, escrow, mezzanine financing, I mentioned, subordinated mortgage financing, all those types of available economic development financing attributes, CPACE bodes quite well in comparison. So eligible improvements, and we'll step through this in the next slide, generally include fixtures, products, systems, equipment, devices, and materials that are intended. Point of emphasis there on the word intended. You'll see the word intended quite often if you review the PACE Act here in Illinois. Intended for energy efficiency, intended for renewable energy, intended for resiliency, intended for water use, and then electric vehicle charging stations are eligible too. Importantly, this goes to the relative aspects of CPACE financing and its attributes that attract both property owners, developers, and lenders to this type of structure. CPACE financing is non-recourse to the record owner. To said another way, the lien that is imposed under these structures is tied to the property and not to the operating company within those four walls. And therefore, CPACE financing is assignable upon transfer of the property. Said another way, CPACE financing, if a property owner sells the property, the next property owner can step into the debt service schedule of this special assessment for these improvements. Or if in the worst case scenario, if there's a default, CPACE financing is assignable subsequent to a foreclosure scenario as well. That's really important. Typically under a foreclosure scenario, you'll find that mortgage financiers accelerate all the debt service that is due over the next 20 to 30 years. As we see here in the fourth and final bullet point, CPACE financing does not accelerate upon a payment or covenant default. And that's important. This attracts lenders over a long term. Quite often, energy efficiency, resiliency, water conservation projects, they simply need a longer runway to result in a cost benefit savings. Your traditional banking lenders will only amortize, well, I should say, will amortize any loan over 20 to 30 years, but they're typically only in the loan for the first 5 to 7 with a balloon payment or a renewal provision baked into the underlying document. So CPACE financing attracts lenders and improves their willingness to offer longer durations for loans. And if you fix that interest rate over a longer duration, it really gives you a good baseline to perform a cost benefit analysis to ensure that your project improvements result in savings going forward. Furthermore, just to put a pin in this slide, CPACE financing under Illinois law actually permits terms of up to 40 years. You only see 40 years for resiliency type improvements. If you think of the Mississippi River floodplain, if you have flood mitigation, that's a type of resiliency improvement. If you think of downstate Illinois, there is some marginal seismic activity. So you may have some seismic retrofits or improvements. But by and large, and Julia will speak to this later from a capital provider perspective, we're discussing commercial real estate. So typically, your vanilla CPACE financing will go out to 30 years. Next slide, Katie. So the linchpin of CPACE financing, of course, is its public purpose. Taking a step back, CPACE financing is a form of public financing, quite similar to the undertaking of conduit debt issuance for a qualified tax-exempt bond project. When I say that, I mean if you're a municipality or a county and you've ever issued conduit debt for an affordable nonprofit multifamily apartment, you're quite familiar with the aspects of public financing. You have a principal borrower, you have a principal lender, but the government sits in between as a conduit, in effect, undertaking these public finance mechanics to incentivize economic development activity. So PACE projects that are permanently affixed to private property, including new construction, as we mentioned on our last slide, constitute a valid public purpose under the Illinois Property Assessed Clean Energy Act that is eligible for CPACE financing here in Illinois as follows. Again, electric vehicle charging stations qualify under state law. The actual statutory term is alternative energy improvement. Energy efficiency improvements quite obviously qualify. Anything that decreases energy consumption or enables a more efficient use of electricity, natural gas, or propane. Renewable energy improvements are quite intuitive. That's your wind energy, solar thermal energy, geothermal energy, photovoltaic cells and panels, solar panels that benefit your property. Resiliency improvements, I alluded to that previously. Those are the type of improvements that will improve your property's durability of its infrastructure, whether it be flood mitigation, microgrids, et cetera. And then last but not least, water use improvements. So any type of water conservation. If you think of a Class A or Class B office property, you have a chilled water system running throughout the building. New water systems will, of course, conserve water, but it also includes some more progressive type of examples, such as green roofs and porous pavement. One point of emphasis for this slide, state law, the Illinois Property Assessed Clean Energy Act, specifically enumerates various types of eligible improvements, but not all. And the reason that is we all are aware, technology is always continuously improving over a long enough timeline. Technology 20 years from now will look vastly different than technology of today. And accordingly, the PACE Act allows for catch-alls such that, for instance, let's say you'd like to install new elevator controls in a Class A or Class B office property. You won't find elevator control as an example of an energy efficiency improvement specifically in the Act, but it does allow for a mechanism where a local government can make the decision and say, elevator controls clearly based on an energy audit provided by engineers and is required under state law are intended to save energy, and therefore we feel as a local government that this qualifies for purposes of the PACE Act, our PACE program, and is therefore constitutes a valid legal public purpose. Next slide, please. So stepping a little bit through the legislative history, obviously it's 2023. COVID severely affected commercial real estate through the last 3+ years. So we thought it was important to kind of step through the legislative history. I mentioned that CPACE financing is available both across the country and on a very limited basis internationally. So this is a state-derived economic development financing incentive. California does it one way, Texas does it another way. So every state is quite unique. So we thought it was important to step through the legislative history, at least here in Illinois. The first iteration of the Property Assessed Clean Energy Act was enacted here in Illinois in 2017. Private stakeholders advanced that legislation, and that original iteration of state law contemplated a limited or no state support model, whereby any state involvement was simply limited to the adoption of the enabling state legislation. However, it was shortly thereafter that it was deemed cost prohibitive at the local level by capital providers and lenders. And additionally, counties and municipalities reported lacking any subject matter expertise and resources to create these PACE areas and establish related PACE programs as allowed for under the PACE Act. So in 2018, the Illinois Finance Authority led the charge to make minor changes to the PACE Act based on US DOE's best practices at the time. More specifically, US DOE released a white paper that recommended a strategic state support model could be more beneficial as the state would develop standard materials, protocols, and offerings such as legal documents, and then counties and municipalities could use as they see fit. That strategic state support model was signed into law, at least the option for a strategic state support model was signed into law in 2018. At that time, IFA representing the state here in this scenario began working on drafting legal documents to offer localities as they advanced implementation of this new economic development tool in their economic development toolbox. And it was shortly thereafter, once we started receiving market feedback, that it was quite clear to everyone that a comprehensive technical rewrite of the entire law was needed. That was undertaken in 2019, and a little bit of a humble brag here. I'm quite proud to report that iteration of the statute was passed unanimously by both the Illinois House and the Illinois Senate and signed into law in 2019. And that remains the law of the land as we speak today. Next slide, please. So about CPACE financing, we stepped through what a PACE project is, what a PACE project isn't. We've somewhat provided examples of types of PACE projects that could be financed with CPACE financing, a little bit of legislative history. And so now it's important to understand how you would actually effectuate a CPACE financing, provided you have an interested record owner, an interested lender, you've established a PACE program. That would be effectuated by the eligible property owner in the PACE area voluntarily entering into an assessment contract. Point of emphasis there on the word voluntarily. The original 2017 state law required the use of the Special Assessment Supplemental Bond and Procedures Act. So state law has always required the issuance of a bond or a note, as does any conduit financing here in Illinois. But importantly, that act, the Supplemental Bond and Procedures Act, is relegated to involuntary special assessments. An example of that would be the East Loop in Chicago, just north of Millennium Park. There was involuntary special assessments imposed on various condominium owners to pay for site work surrounding the new condominium projects. That required a board of local improvements, that required a judicial sign-off. CPACE financing is voluntary. You have two principals in the transaction. You have a property owner or lender that want to enter into this type of financing to fund a project. And so therefore, We rewrote the statute in 2019 to reflect best practices that did not require Board of Local Improvements, that did not require judicial sign off, but maintained the conduit debt practices that were originally authored in 2017. So to effectuate a CPACE financing in a county or municipality, the property owner signs an assessment contract with one or the other local government, and then the local government that has signed that assessment contract issues conduit debt, albeit a bond note or other name for evidence of indebtedness, that is secured by that assessment contract as collateral to fund the PACE project. And such conduit debt, again, whether you call it a bond or a note, it doesn't really matter. It's still a conduit debt instrument. That conduit debt instrument is repaid through the special assessment that is imposed on that particular property pursuant to the schedule attached to the assessment contract and recorded with the local recorder's office. Importantly, the related conduit bond or note that has been issued by the county, municipality, or the Illinois Finance Authority is never a general or moral obligation of neighboring taxpayers. This is important. This stands in stark contrast to what our local economic development officials are familiar with vis-a-vis special service areas. If you think of a special service area, for instance, State Street, there's a special service area in downtown Chicago where there's private security to supplement the Chicago police officer force. Each property owner in that scenario pays a pro rata amount, I should say, of the bill due for that extra security. CPACE financing is not operating in the same fashion whatsoever. In fact, only the property owner that signs the assessment contract is responsible for that repayment. Neighboring taxpayers are not responsible for the repayment under any circumstance. And should the property owner not make the payments that they have agreed to with the local government and with their lender, then a workout scenario would take place, but only the property owner that has signed that assessment contract, the collateral for that financing, would bear the brunt of such foreclosure scenario. So the assessment contract, which is the collateral, think of your conventional financing with a bank. You have a mortgage as your conventional collateral. For CPACE financing, the assessment contract is your collateral here in Illinois. The assessment contract will reflect the business terms and conditions of the proposed CPACE financing. That's recorded with the local recorder's office, quite similar to a mortgage. That's done by a bond counsel or a title company or the lender. And that thus constitutes a lien against the applicable property, quite similar to a mortgage. Therefore, the lien runs with the property until the special assessment is paid in full. Once a special assessment is paid in full, it is discharged. And then capital providers, importantly, are entitled to the powers and rights that the local government would have regarding delinquent property taxes. So again, this looks much like mortgage financing, when a mortgage financier does not receive payment of principal and interest. They can enter into a workout scenario with their client. If that workout scenario fails, they then notify the county that they'd like to pursue foreclosure proceedings. Same thing here with CPACE, entitled to a workout scenario. If that fails, then they would pursue foreclosure. Next slide, please. So slide 10 kind of steps a little bit through PACE program structures, at least what we see the most here in Illinois. I've alluded to this a few times. Under Illinois law, any county or municipality may create a PACE area and establish a related PACE program. The PACE Act itself permits counties and municipalities to self-administer a PACE program, but this scenario, importantly, is extremely rare across the United States. In fact, I couldn't find any live scenarios where this remains the case. This is really a vestige, at least this example of structure is a vestige of the CPACE market 10 years ago when it originally got started in California. This market is quite more sophisticated than it was 10 years ago. In fact, the market today is much more analogous to commercial mortgage-backed security financing than anything else. Another PACE program structure that we see quite often in Illinois is a PACE program that is administered by a single capital provider or its affiliate. That single capital provider or its affiliate will have been granted exclusive program administration rights for all potential CPACE financings, regardless of source bond or note proceeds. Colloquially, we refer to that as a private label PACE structure. Just by way of example, if you think of the city of Chicago, they have a private label program. Their program is administered by a joint venture of a capital provider and a local underwriting firm based in Illinois. But Cook County is also a private label structure as well. Cook County has engaged an affiliate of a single capital provider to administer its PACE program. So that structure has been quite predominant in Illinois over the last 3 to 4 years. And then we have a third structure, relatively new as of early this year, and that's the Illinois Finance Authority PACE program is a state agency that permits capital providers to administer and service their PACE projects that they originate without any exclusivity. We refer to that as an open market structure. That should sound quite intuitive. If you think of mortgage financing does not have any exclusivity within Illinois, right? Any mortgage financier can administer and service its own mortgages with its own clients without having to work through a competing capital provider that has received exclusive program administration rights. So those are the three predominant programmatic structures. But importantly, that's enabled at the hyper-local level, right? You can have a county PACE program, you can have a municipal PACE program, you can have overlapping county and municipal PACE programs. In effect, the property owner situated within both would have optionality. They could pick and choose which PACE program works best for themselves. But importantly, under Illinois law, it's only the county or municipality that can sign the collateral and enable a PACE program. But there are three ways to finance PACE projects. The county can issue a debt instrument on a conduit basis. A municipality can issue conduit debt, whether it's a bond or a note. And the third option is the Illinois Finance Authority, as a state agency, can issue the conduit debt on behalf of the county or municipality as well. So going back to our Chicago and Cook County example, you have a bit of a hybrid with Chicago. So the city of Chicago has an exclusive program administrator, but Chicago took the step to say, you know, we as a city would rather not explain away this conduit debt for these PACE projects on our audited financial statements when we try to sell general obligation bonds for the city's purposes. We'd rather have IFA as a state agency issue this conduit debt so we don't have to. Whereas Cook County has a private label program as well, but Cook County is issuing its own notes and not utilizing a state agency to undertake that debt issuance. So there's various permutations, is probably the best word for this slide, of how CPACE can be enabled. But what's important to understand is these programmatic structures can be quite costly to develop and launch. Putting Illinois aside, my general conversations with capital providers in other states, they report that the cost of these programs to develop, launch, and function can be anywhere from $750,000 to $1.5 million, and that's not even discussing the ongoing cost of operating the program. So obviously, this hyper local economic development financing incentive is quite expensive, and a way to reduce the cost of capital is to try to standardize the market. And so that is the rationale for that third permutation, where the financing of these projects is standardized from across jurisdictions. As you can imagine, with lenders on the West Coast and East Coast and Sunbelt, especially where CPACE financing is already quite ubiquitous, they want their Big Mac in Chicago to taste like a Big Mac in Quad Cities, to taste like a Big Mac in Springfield. And so really that's the rationale for the third permutation. But certainly, as we see here in Northeastern Illinois, the private label structure has been widely adopted in the early years of CPACE financing being available here in Illinois. So with that, I'll turn it back to Katie and Julie for a capital provider's perspective. Thank you so much.
Thank you so much, Brad. Really appreciate it. I told Brad when we were setting up this webinar, I've heard CPACE explained to me a lot of times, and it's still learn something new every time. So thank you for helping navigate this concept for all of us and all of these different structures and how it's set up. Next, we're going to have Julie Sommese join us. She is the managing director at Pace Equity. Julie considers herself a recovering banker after having been a commercial banker for over 30 years. Having most recently served as the chief lending officer for a community bank in the Chicagoland area before leaving to join the PACE world. She has always focused on relationship banking and continues to do so at Pace Equity. Pace Equity, where Julie works, pioneered Pace financing in 2010, and through their own investment fund, have helped finance over 400 projects. Julie enjoys educating people on the benefits of PACE and is always happy to answer questions about it, which I agree with. So thank you, Julie, for answering all of my questions over time and everybody's questions today. I'm going to turn it over to you to start talking about the benefits of PACE.
Thank you, Katie, and absolutely always happy to answer questions. I know it can be, as Brad mentioned, it's relatively new to Illinois. So we're all sort of learning about it as we go. And Brad discussed really, as you know, the history, the mechanics, the program structure of PACE. As a capital provider, I'm going to talk a little bit more about the why. Why would you want to use PACE, and how is it going to benefit you and help you get your project completed? So very similarly to what Brad just discussed, PACE it's a low rate, long-term, non-recourse, mortgage-free way to help complete your capital stack. PACE is significantly cheaper than mezz debt. So we're typically, and of course, like any other debt product, it's going to depend on the actual metrics of that project. But we are very similar to what a senior mortgage on a property would be. Very, very similar. So significantly cheaper than mezz debt. We also have no ownership control, which a lot of times can happen in a mezz or a preferred equity scenario. In fact, with PACE dollars, with PACE financing, there are no ongoing financial covenants. There's no ongoing financial reporting. And as Brad mentioned, we are non-recourse, so no personal guarantees involved. And with the amortization of up to 30 years, it helps you sort of stretch out those capital improvements. Okay, next slide, please. So we're able to fund in nearly all asset classes. Sometimes I tend to say that it's easier to say what we can't fund rather than what we can. But we are very active right now. We're very active in senior housing, the office market, retail, hospitality, industrial, and multifamily. And I believe Brad mentioned this as well, but we can be used for not only new construction, but renovations, deep renovations, complete redevelopment projects, and of course, renewable energy. Next slide, please. So, and again, Brad touched on this, but as you all likely know and are very well aware, we have been in a challenging lending environment for over 18 months or so now, as banks are kind of pulling back on their lending. In some cases, banks aren't lending to new customers. In some cases, they're not lending on new construction. Banks are kind of trying to figure it out right now as well. And that actually is a perfect time for PACE to sort of jump in and fill that gap and help you complete a capital stack. As lenders are looking to reduce that leverage in a project, we can kind of come in and fill that percentage that isn't being filled. And this slide actually is a little bit outdated. I kind of suspect for 23, 24, and 25, it may even outpace what we project because of all of these this challenging lending environment that we're in right now. Next slide, please, Katie. All right, so this slide illustrates how PACE can impact your equity investment. And that's what we're all looking to do right now. How are we going to we have our project, how are we going to get this project financed? So as you can see on the stack on the right-hand side, with the introduction of PACE into that cap stack, it's reducing the equity. It's reducing the equity needed to 15 to perhaps 20%, where the conventional debt and equity on the left-hand side, especially again, this is representing where lenders typically are today from a loan to value standpoint. You know, your equity becomes 15 to 20% rather than 40 to 60%, and gives you the opportunity to maybe not reach out to those mezz folks or reach out to those preferred equity folks. So, and then this is probably also a good time to sort of jump in. And again, Brad briefly touched on some of the underwriting aspects. So when we are, as a capital provider, when we're looking at a project, we have several underwriting guidelines that we are looking at. We usually start with the loan to value. We can go up to, again, Brad mentioned this, but we can go up to 25% of the stabilized value of the asset. That's how much we could potentially put of PACE dollars into a project. That's where we start. And then we're also looking at other aspects, like any other lender would, debt service coverage requirements, et cetera. And that's sort of how we begin to size the PACE equity that we're putting in. Next slide, please. So one of the questions I get asked a lot and pretty frequently is, can PACE work with other financing tools, such as new market tax credits, historic tax credits, et cetera? And the answer to that is yes. PACE can actually be very, very flexible in a cap stack. This slide is actually a real project that we closed on not too long ago. And as you can see, this sort of, it illustrates all of the different components that went in to putting this project together and getting it completed. The cap, in addition to us, and we were in at 18%, but in addition to us, as you can see, there were federal HTCs, there were state HTCs, 2 separate construction loans. There was even a CDA loan. So we can get in and sort of work with all of these different groups to help you get the project done. We can also work with TIF. We can work with local state grants. Those are groups that, you know, we work with and sort of dig in with them to get you to a completion. Next slide, please. So now this slide, I realize there's a lot going on here, but what this is really illustrating is the benefit of using PACE to the IRR of the project and sort of your combined loan to cost. So if you focus on the 2 bottom lines there of the slide, it's really showing that in scenario 2, where PACE came in, put a chunk of the cap stack together. So there was an increased IRR on this particular project, and this developer was able to go from a 69% loan to value or loan to cost to an 82% loan to cost, effectively requiring much less money out of their pocket to get this project done. Next slide, please. So I want to briefly mention, I don't want to get too far in the weeds on this, but we at PACE Equity, we actually offer a low carbon PACE product in addition to a standard PACE product. And basically what this is our serious low carbon. There are certain specifications that if a developer builds a building to substantiated low carbon specifications, there's actually a reduced interest rate. So this is just a slide to sort of show, but by, you know, especially because we're talking about, you know, we're all part of the Illinois Green Alliance. So for building a more low carbon sustainable building, this was a larger project. It was a $51 million development budget. But by reducing that interest rate with the low carbon specifications, They also saw an impact to their property value from an improved NOI. And then with the new specifications that they met that were low carbon, they saw a better energy savings. So this particular sort of case study, they were able to realize a positive net financial impact of $709,000. So PACE can have a pretty significant impact to your bottom line due to some of its structures. All right, next slide, please. I also want to briefly touch on the role of the senior lender in a project including PACE financing. One of the questions, and I'm sure Brad gets it also as well all the time, how do senior lenders feel about PACE? Because almost 98% of the projects we do, there is a senior lender in place that's providing, a big chunk of the debt to get the project done. And senior lenders do have to consent to having PACE in the capital stack. They have to consent to having PACE as part of the funds going into the project. So a lot of times there's questions on their part. A lot of times the lenders don't realize that we're not taking a mortgage, just as Brad mentioned. We're taking an assessment contract. There's an assessment contract. So we don't have the rights of anything in a mortgage. So we have worked with over 300 lenders across the nation. There are banks out there that consent to it. And most times it's literally just an education on the part of the lender. And again, that's what I like to do. And that's what I spend a lot of my time doing. But we just spend some time with your banker explaining it and walking through how we work together and how we function in relation to them. Next slide, please, Katie. And this is really the last thing I want to talk about today. And Brad briefly touched on it, but I think this is a really interesting component to PACE that a lot of folks don't think about and don't realize is a capability of PACE. But we can actually look back in the state of Illinois, we can look back up to 36 months from certificate of occupancy and finance or refinance any of the PACE eligible measures out of a project. So this can be helpful in several different ways. It can provide, if there was no PACE on the project to begin with and the project is completed, we can go back in, take those measures, finance those through a PACE assessment, and in essence, give you that liquidity back. We did a lot of this during COVID, a lot of it in the hospitality, the hotel world. So where a hotel owner had either just completed new construction or just completed a large renovation project, and then the world literally shut down. We did a lot of these retroactive refinancings, took in most cases up to that full 25% loan to value, stabilized value of the property. And they took that cash and they kept their senior lenders whole. They right-sized their senior debt in some cases. And then they, sort of had cash reserves to get them through that period. Retroactive refinancing can also be done mid-construction to cover cost overruns. We've been doing a lot of that recently as sort of, again, in the last 4 years since COVID and the world has shifted, construction costs have really increased. So projects that were already underway and have now seen $2, $3, sometimes $5 million in cost overruns, we can jump in mid-construction, refinance those PACE eligible measures that are in the property and help sort of cover the rest of those cost overruns. And then we've also seen folks use it, the project's completed. Again, we can look back 36 months. And they refinance some of that liquidity out and they're paying down or even paying off their much more expensive mezzanine or preferred equity. So I know that was a lot. And again, I'm always happy to answer questions because PACE is one of those things, the first time you hear about it, you're kind of like, what? So happy to answer anything. And Katie, I'm going to turn it back over to you at this point because I know we have some time for some Q&A. I saw a couple of questions popping up, didn't get a chance to really look at them, but I'm going to turn it back over to you for the Q&A session.
Awesome. Thanks so much, Julie. And before we jump into Q&A, I'm just going to put this slide up here in case anyone wants to take a picture of it or a screenshot so you can follow up with Brad or Julie directly. We'll also be sending their contact information in a follow-up email for all of the attendees. So if you have any more specific questions, you can follow up more directly as well. But I am going to jump over to discussion and questions and want to thank Julie and Brad again for explaining complicated topic in a way that I think helps everybody understand a little bit more clearly how you can use this product and use this tool in your financing of eligible projects. I am going to start with one quick question while I pull up my question document. One thing that I just want to reiterate, because I know I get this question a lot at Illinois Green, is just clarifying. I wonder if maybe Julie, you could start and clarify when you meant the type of projects that are eligible. CPACE is described as commercial PACE, but really multifamily residential projects are included in that. Could you just define that one more time on the type of residential project that is eligible for CPACE in Illinois while I pull up the other questions?
Sure. And you're right. So there's sometimes sort of confusion between residential and multifamily. In the commercial real estate world, anything that is 5 units or more is really considered multifamily. And I know it's residential and folks are living there. So it absolutely can be used for multifamily. When we say it can't be used for residential, that is a single family, family living in the home, that we cannot do.
Awesome, thank you. And can I also just ask too around the size of a project? Because I think this is in a similar line of question. And Brad or Julie, whoever wants to jump in first. But you mentioned who is eligible and that this is not a retail banking product. It's expensive to get done. And so it's going to be a more expensive type of project to take place. So is there a typical kind of size or dollar amount of project that is seen in PACE, or a kind of like a range?
Sure, I can jump in on that one. It's a wide range. It's actually a very wide range. On the minimum size, we have done and we'll look at projects like 500,000, 650,000, and that's in CPACE dollars. So that may be a $4 million project. Mm-hmm. The fees sometimes and some of the costs that go along with the PACE make it cost prohibitive to go that low. We typically say from a financial standpoint, a financial benefit standpoint for a borrower, about $1 million in PACE is a good place to start. On the upside, there really is no upside where it doesn't make sense. Again, it all goes back to that 25%. It can't be more than 25% loan to value of the completed project.
Thanks, Julie. Brad, did you want to add anything to that? Or you're good?
Yeah, no, Julie hit the nail on the head. But it's also important to understand the context. We're in a very high interest rate environment. Mm-hmm. So any prospective property owner, because we're talking today about a financial product, one of many financial products available in the commercial real estate debt space. So, on a relative basis, is CPACE financing more affordable than mezzanine? Yes, almost always. Is it better than a developer or property owner reaching into their pockets to come up with additional cash? Of course, it's better. But in a high interest rate environment, I think that relegates the lenders to projects that have a higher amount of CPACE financing because of the fees that are required of this institutional financial debt product. If the interest rate environment was lower, as it was just a year and a half ago, I think you'd see lenders willing to go lower perfect example, when IFA as a state agency first started undertaking these conversations in late 2017, when federal tax reform was on the table, and certainly, well in advance of COVID. I think a lot of capital providers were at $250,000, maybe 300,000. But as interest rate environment has gone higher these last 12 to 18 months, I think that is increased the minimum project size where property owners can still fulfill that debt service schedule. Higher interest rate means higher cost of capital. Higher cost of capital means higher debt service. And so that's a limiting factor when you have a high interest rate environment like we do today.
Thank you. Brad, can I ask you another one? Is off-billing or collecting of special assessments permitted under the Property Assessed Clean Energy Act? And why would someone need to know this answer?
Yeah, so great question. That was one of the, there were several, but that was one of the main rationales for rewriting the PACE Act in 2019. If you think of debt financing in terms of mortgage financing, we're all quite familiar with receiving our mortgages in the mail from either our lender or our lender servicer. Before 2019, state law required that either the county or municipality bill and collect. And the market felt that it should have the option for workout scenarios, just as they do with being secured by a mortgage on a conventional basis. But they also felt it was worth having the option to bill and collect themselves to reduce the fees that go into these transactions. Quite typically, if you're going to require a county to bill and collect, that means that the county perhaps has to update its software, perhaps has to update its hardware, but certainly the county is going to require a fee for undertaking that service. Otherwise, and it's an administrative burden borne upon the respective local governments. So in 2019, when state law was comprehensively rewritten, off-billing and collecting of these special assessments was specifically allowed, which means that today, a capital provider can bill and collect on a separate piece of paper, on a separate envelope. It does not need to be semi-annually as property taxes are billed and collected. It can simply be a reflection of the business terms and conditions it's agreed to between a property owner and the lender. The county is only notified of the foreclosure scenario at the capital provider's direction. But importantly, should a project be in foreclosure, that is not adding to the administrative burden of any county collectors. In fact, as we all know, you can't pick and choose what property taxes you pay. We can't pay the library district, but not pay the fire department. It's either all or none. And so if a property is in foreclosure, it's also likely that the library district did not get paid, the county did not get paid, the municipality did not get paid. So that property is already undertaking the foreclosure proceedings. This, in effect, is just an additional line item in that waterfall scenario through a foreclosure proceeding. But what's important to remember here in a foreclosure scenario, in Illinois, foreclosure takes, at best 2.5 years, sometimes 4 years. But CPACE does not accelerate. This kind of goes back to slide one, our foundational baseline. The mortgage financiers are really the ones that tip the scales. The mortgage financiers are going to accelerate 20 to 30 years of debt, whereas a special assessment at any given time in the foreclosure process is only 3 to 4 years outstanding. It's not accelerating. So the idea that a special assessment will tip the scales, if you will, into foreclosure is not really the case. It's usually the mortgage lender that's tipping the scales, accelerating all that debt service. And by the way, this is an emerging market. This is a niche industry. Quite often what happens on a practical basis is the mortgage lender, because they have so much skin in the game, albeit 55% LTV, 75% LTV, they're the ones that end up paying the local governments those back due taxes. The mortgage financiers are the ones that end up paying that special assessment, that voluntary property tax that effectuated the collateral for the CPACE financing. So from the capital provider's perspective, they're quite secure, both on a long-term basis and through a foreclosure basis. And so that is why CPACE financing attracts lenders to these type of projects. It's for all of those attributes that they reach a critical mass of, hey, this really works for us.
Thank you, Brad. That's really helpful. I have a couple of audience questions that are maybe looking for a little bit of clarification on some things that were said. So Julie, could you explain what in the slide where you had the capital stack and all the different loans and things that were going together to make up the total financing strategy, you mentioned the federal and state HTC. Could you
Yeah.
describe what that is?
Sure, those are historical tax credits. So, and there are both local or state historical tax credits, and those are just what they sound like. They're tax credits back to the property owner.
Gotcha. Thank you.
Sure.
And I think that you both have mentioned this multiple times throughout, but I want to make sure because we have a lot of facts and a lot of numbers today. So for CPACE, I think that you guys described this, but just to reiterate again, what are the typical interest rates for a CPACE loan?
So we typically, again, it really depends on the metrics of the project. But right now we are very similar to what a senior lender would be. So think anywhere from, and again, it's so hard to put a number on it until we actually look at the project. But very generally, let's call it very generally, I think 7%, 7.5%, right around what senior lenders are looking at these days.
Great. We just have a couple minutes left, so I am going to start wrapping it up and put you both on the spot for something to make sure everyone knows when they leave here today. If there was one thing you would want people to remember or think about or take action to look into a little bit further when they left the webinar today or when they're back at their desk looking at these slides, what would that be? And I'm gonna flip it to Julie first.
Okay. You know what, really just to, I want to say this the right way, but to not be afraid of PACE. I think a lot of folks start to explore it and then they kind of go, oh my God, there's so much here. But don't be afraid to get in and sort of learn about it. It can be a very attractive tool, especially in today's environment. It can be a very attractive tool to get you to the finish line in financing a project right now.
Awesome. Brad?
Well, Julie said the same thing I was going to say, so kind of unfair. So I'll just a little bit of additional color. Again, I don't know how else to say it. Julie said what I was going to say. It's new, but that doesn't mean it's hard. I think because it's new, that means that people need to educate themselves. What I would say to that in response is you have good government people throughout Illinois. I'd like to think I'm in that category. You know, I'm an agent of the state. You have local economic development officials that have begun learning about CPACE. It is an emerging market. It's only 10 years old. But that being the case, we're at a point in time where this industry has reached a sophisticated level. This industry has hired local boots on the ground for origination of PACE projects, for marketing of available dollars for potential developments. So certainly no one is left alone learning about this. Feel free to reach out to the Building Hub, to Katie, to myself at IFA or Julie. So that would be my main takeaway. But if you strip away kind of the esoteric terms relative to CPACE financing, at the end of the day, this is really just a debt instrument. There's a borrower, there's a lender. It gets a little dressed up in the sense that it's conduit debt. You have bond counsel provides an opinion. You have a program administrator or lender itself as its own program administrator that ensures validity under the act and under the program guidelines as they differ from jurisdiction to jurisdiction. If you strip all that away, it's really just a conventional loan. The difference is rather than being secured by a mortgage, it's secured by a voluntary property tax. The term for voluntary property tax is special assessment. It does not affect neighboring taxpayers. It's just debt financing. And so if you have a gap in your project budget, I think we would all admit you'd be well advised to at least consider CPACE financing, because you considered it relative to other forms of debt financing. like junior subordinated mortgage financing, mezzanine debt financing, preferred equity, or just straight equity cash. CPACE financing offers a lot of attributes, especially given the fact that the linchpin for this, the public purpose for this, is that it is intended to make your property more energy efficient, more resilient, better conserves water. And that being the case, these mechanisms, this public finance mechanics, if you will, really attract lenders to provide a lot of capital. To what Julie said earlier, there's no maximum dollar amount. We've seen projects in the industry fairly recently exceed $100 million of CPACE dollars, for projects that were 400 to 500 million in total cost. So there's really no maximum. It's really, whether or not it pencils out on the smaller side. We will all in this industry readily admit the most underserved market is, the corner grocery store that wants to improve its HVAC. Will CPACE financing ever really work for those type of deals? It remains to be seen. I think everybody's striving to get that. But the best way to do that is to have a really good statute to make CPACE financing look like something the market understands. In this aspect, it looks like conduit debt. And so we can all thank, the collective state of Illinois for really taking a look at other states, developing best practices, developing a gold-plated statute to the point where other general assemblies in other states are actually revisiting their existing state laws for CPACE financing and updating it based on the way Illinois reads. And so you have a good statute, you have good government economic development officials at the local and state level. So really nobody's in this alone. Feel free to contact any of us and we can work together and collaborate.
Thank you so much, Brad, and thank you so much, Julie. Thank you for everyone for attending. And we will send out the follow-up email with the recording. So thank you all and have a wonderful afternoon.
Thank you so much.